Hey, what's up guys? Welcome back to my channel. Last video, we talked about how we were able to correctly predict this move where Bitcoin actually ended up crashing. And we did this by looking at the fear and greed index and extrapolating patterns from that cycle. So for example, here in the fear and greed index, right, what the move we were looking at was this slight uptrend. You see up here, it was like trending upwards. Then you can see down here, the fear and greed index was flashing, then it crashed. And that also happened here in the top part. You know, the very top of this part was the flash of the fear and greed, and then it started going down. And we were seeing this pattern play out again, where it was slightly trending up, and then during this stop, we were having the fear and greed index, and now it's going down. So we actually called this almost exactly, and you see that it did actually end up falling down almost exactly how we predicted it to be. So the question now is, with the current crash, should we start buying Bitcoin, right? Or should we start buying any of these crypto assets? So there are a few things to consider here before I talk about the investment strategy that I use. One, I do think that when you look at the price of Bitcoin, so this is like the risk-adjusted price of Bitcoin, right? You can see, for example, that there seems to be kind of like a downtrend here. So like the first cycle, it was all tops at 1.0 risk. The next cycle, it was slightly flashing the top at 1.0 risk, and then it didn't. And then now we didn't even reach the 1.0 risk, right? And if you look at bottoms, it's also getting slightly lower, right? So when I look at this chart, I feel like it can go slightly lower than the previous cycle as well, in terms of this trend. But if you just look at this cycle, or if you just look at this chart, you can see that it does kind of like bottom-ish at this 3.0, yeah, at this 0.3 level. And we just hit it recently. There are some brief dips to the bottom here, but you know, is that going to happen this cycle? Right, so that's the question. Are we going to get lower than the current level we are? Are we going lower than 60K? I know in the previous few videos, I said that we were going to hit 50Ks. Technically, we did hit 59K, so you know, we already technically reached 50K level. But yeah, are we going to reach lower levels here? And the question we want to answer is, should we buy right now? Right. So given that, I want to go back to this EV dice roll chart that we made. And again, none of this is financial advice, but this gives you an idea of how you should look at the market, or how I look at the market in a more data-driven way, right? So how do these graphs work? And how does this allow us to actually decide whether or not to buy an asset, right? So how these graphs work is basically, historically in the risk level, it gets all the historical risk levels, and then it looks at the price one day for the daily after that risk level, and then it compares from the previous day if that price went up or not, and what's the average gain based on all of the prices. So what does that mean? So basically here in this graph, we look at, for example, this one is 0.3 risk. It looks at one day after if the price went up or down for all 0.3 risk levels in this chart, and then it averages the return of all those 0.3 risk levels. And it does that for all of these risk levels. So it gives you kind of a chart on, okay, on the daily, after one day, given that we saw 0.15 risk, what is the average gain in one day, right? Then weekly is what is the average gain from seeing any 0.15 data point to 1 week. Monthly is 0.15, 1 month after, what is the average gain? And then we do that for every risk level, and you get it yearly is year and 2 years to year. So what do you notice? What you notice is that the higher the time frame we have, the more separation of the low risk and high risk is in terms of return. So for example, in the 2-year, you can see that at around 0.6 risk, you get positive return, and around 0.65 risk, you get negative return. So when you look at the Bitcoin risk chart, generally when you're up here, in a year, it has a higher chance of crashing. You have a higher chance of getting a negative return if you invest up here than if you invest down here, right? So that's basically how this EV dice roll works. It's giving you an expected value of, depending on your time frame, of what investing at a given risk level would be like, right? So right now we're at 0.3 risk, and it says here that on average, based on all of the previous 0.3 risk levels that we've experienced, if you invest in 0.3 risk now, you would make an expected gain of 106% on Bitcoin, right? So the question is, should you buy now? Is it going to get lower, right? So this is an expected value. So that means that on average, you will make 106%. But that's not guaranteed. This is expected. So like, for example, if we do a gambling game with a coin and on heads, I pay you, but on tails, you pay me $5, right? The expected value for that is $5 on average for you because 50% of the time you'll flip heads and 50% of the time you'll flip tails. But since I'm paying you more than what you pay me, on average you're gonna make $5. So this is the same thing. There are times where we have seen historically Bitcoin reach 0.3 risk and still lose money, right? So we can see, for example, in this chart, there are times here that reach 0.3 risk. So like over here when it was falling, it reached 0.3 risk, and then it still fell down. There are times here where it reached 0.3 risk, right? And it still fell down. But on average, all of the 0.3 risks, if you look at it 1 year later, you would have made money on average, right? On a yearly time frame, and even more so in the 2-year time frame. So the longer your time horizon is, the more likely you are to get a higher expected return from the Bitcoin chart, right? So, I mean, that's the question again. Should you invest? Is this a good opportunity for us to invest money in Bitcoin right now? If you're looking at the 2-year time frame, yes, you're gonna probably make money. And if you're looking at the yearly time frame, yes, you're probably gonna make money. But this expected values, you could still lose money, similar to the coin flip idea, right? So yeah, not financial advice, but yeah. But the second question is, given this information, what do we do with it? Like, do we just all in Bitcoin now? Do we get all of the funds that we would allocate to Bitcoin right here in this 0.3 level? It could still reach 0.15 risk. It could still reach 0.2 risk. What if it reaches 0.15 risk and I already used all my Bitcoin allocation cash at 0.3, right? And this is where I create the buy table. So this is the buy table that tries to quantify the risk of certain milestones in Bitcoin, right? Because you really want to think of this as a random process, just like the coin toss, right? You won't make money every time, but you want to create a strategy wherein you're okay if you lose or you still win majority of the time. So in the coin toss strategy, you make money, so you probably play it all the time. In this strategy, you can think about each of these risk buckets, as a coin toss strategy with an expected gain. If you see a 0.7 coin, you might not want to flip it because in the next 2 years, you're probably just going to lose money, right? But if you see a 0.3 coin, then you might want to flip it because you're going to make money. But given that information, should we flip the 0.3 coin now, or should we wait for, a higher chance of getting a better coin in the future, right? So this is what the bias panel does, actually. It gives you a distribution of the different risk levels of the backtested model. And then it quantifies what is the probability that you would see that risk level, right? So for example, when you look at all data, the probability of seeing a 0.3 risk level is 15%. 15% of the time in the entire chart, we stay at 0.3 risk, right? At 0.25 risk, we only see that risk level 3.7% of the time. In 0.2 risk, we only see it 2.2% of the time. And at 0.15 risk, we only see it 1.5% of the time. So going back to this Bitcoin chart, right, we go to this risk chart. You can see we spend much less time at the lower risk levels than the higher risk level, than the middle levels. Because in the middle levels, you're kind of like hanging out there a lot. But in the bottom risk levels, like you just tap it. The first cycle here in our chart, we didn't even get to the 0.15, right? But we got to that in this cycle. So, okay, the question we're trying to answer now is, should we all in the 0.3 risk level coin toss, or should we wait and allocate funds later on, right? So we're trying to create a strategy that maximizes our expected gain given the distribution of coin tosses. And in order to do this, again, this black line is the distribution, the percentage of time it spends at those risk levels, at the positive risk levels. So, and this preset is, what is the distribution of your allocation would you allocate to that risk level, right? So for example, if you do equal, that means at 0.6 risk, you would put in 10% of your portfolio. So you would put in 10% of your portfolio at 0.6 risk, and then if you add all of these, it'll be 100%. So let's say for your Bitcoin allocation, you have, let's say, $100. You would put in $10 at 0.6 risk. You're going to put in $10 at 0.55 risk, etc., etc., etc. So that's the equal allocation strategy, right? So you just cover the entire positive spectrum of your expected gains. On average, that will make you 15% on the yearly and 13.6% on the 2-year, right? So if you had just spread out your total allocation in like the risk levels, you would make around 14%, right? The maximum you would make is 41%. That means that if it went all the way down to the lowest risk level, if Bitcoin crashed all the way down to 0.15, you would have made 41%, because expected gain is higher at the lower risk levels. So all of your $10 buy orders would have been fulfilled, right? So think of these as like buy orders. Oh, I put in a buy order at 0.6 risk. I put in a buy order at 0.55 risk. And then the cycle bottom is wherein it's random. Sometimes it'll bottom at 0.15 risk. Sometimes it'll bottom at 0.3 risk. We don't know. So it's like a random process based on the distribution of the historical values. Right. So this expected realized gain is actually the average of the distribution. So given that sometimes we land on 0.5, sometimes we land at 0.15, on average you'll make you'll make 14%. And at best you'll make 41%. Now you can change the distribution of your allocation, right? So from equal, you want to make it linear. You can see your expected realized gain gets smaller, but your max gain gets higher, right? So you can see on the equal distribution, you would have made like 41%, but on the linear, you would have made like 46%. So what does this mean? This means that if you adopted this buy strategy, you would have made 46% if it went all the way down to 0.15 risk. And on average, if you're just following, a dice roll, oh yeah, the lowest it'll be is based on the distribution of previous rolls, then you would make just like 10% with this strategy, right? So basically, you can trade some of your average gain for, more. You can trade your average gain for more max gain, and you can trade more max gain for average gain, right? You can bet it all at 0.15, but if you bet it all at 0.15, 95% of the time, actually 98.5% of the time, we might not reach 0.15. So based on historical data, 98% of the time, we never reached 0.15. So for example, if you all in 0.15, your best gain on the yearly, your max gain would be 62%, right? You have much higher upside if we do reach the 0.15 risk level. But, since it doesn't reach the 0.15 risk level 98% of the time, if you ran this simulation an infinite number of times or like 1,000 times, on average, you would have only made like 1%, because 98% of the time, it wouldn't have gone to that risk level. So the money that you would have allocated at 0.15, you never got to allocate, right? So it's a trade-off. Should you invest money now into this risk level, or should you wait but have the chance to not invest because it never reaches that price? Maybe you're waiting for 30,000 Bitcoin, but it never reaches 30,000, right? So this is what this means basically. And with investing, everything is a trade-off. You are simply basically kind of guessing and hoping that, okay, this is the average that I'll get and I'm okay with that. Or are you willing to have less average gain in exchange for the potential of a higher gain, right? And so how this chart works. Right now, for example, you get all risk. It's around 10%. But obviously, we're not investing in everything. Right now, we're already at 0.3 risk, right? So you can change it from steady state to current risk, right? So now it's only considering 0.3 and below. You can see this is the curve for 0.3 and below. Yeah, so right now it's saying there's a 16% chance we go down to 0.25 risk, and there's a 6% chance that we hit the 0.15 risk level, right? So in this scenario, if you do linear linear investing. So basically, you will allocate 40% of your money allocated to Bitcoin at the lowest risk level. But right now at 0.3, you're only allocating 10%, right? That'll give you an expected gain of 10.3%, because yeah, there's only a 6% chance that you're actually going to invest 40% of your portfolio. Right? But if it does go all the way down, you'll make 52%. And so you can just play around with this actually. So right now, if it's equal, if you're just gonna invest 25% of your portfolio at these risk level, then when it goes down, put another 25%. Your expected realized gain on the yearly is 15%, and on 2 years it's like 41%. Yeah, so that's how this will work. Basically, I tend to lean on maximizing the expected gain, or if the difference between the expected and the best is quite small, then I'm okay with that. So for example, these are pretty high, right? So for example, if you go for linear here, there's only 4 risk levels it can go to right now. Obviously, there are caveats to that, but based on historical data, this is how it looks like. If you do linear right now, your expected gain is only 27%, right? And your best gain, meaning if it goes all the way down, is 132%. But if you do equal, your best gain is only 10% less, but your average is like almost double, right? So probably this is a good time to actually allocate some percentage of your portfolio, if you have cash, into it. Into Bitcoin. So that's where my head is at. I'm probably gonna invest a bunch into Bitcoin in order to fill like these strategies. But yeah, what does that mean exactly, right? So if you do put in money at 0.3 risk, you still have a 16% chance for it to go to 0.25, to go to 9.7, to go to 6.7. There's always a risk of it falling, right? So for example, if you invest now at 0.3 risk at 61K, it can still go all the way down to 39K, right? And how much of a fall is that? Right? How much of a fall is that? So let's say 61, so 39 over 61. So that's a 36% drop, right? So if you invest 25% of your allocation now into Bitcoin, be mentally prepared that it is possible for it to still drop 36%. And you're gonna say, hey, am I okay with that? The converse scenario is you invest when it reaches 39K. But are you okay with missing out if it never reaches that, right? I will only invest all my money at 40K Bitcoin, but it turns out that it never reaches 40K Bitcoin. A month from now, it's like at 80K again. Are you okay with that? Are you okay with missing out, right? So investing is inherently a game of decisions and weighing your pros and your cons and what you're willing to give up. And that's really what this bias thing is trying to show, that you can bet everything at the last risk level, right? And at most you will win. If it works out, you will make 62%. But if you played this game a million times, rolling the dice, if it's gonna go to that 0.6 level, you only have a 1.5% chance of reaching the lowest risk level and actually cashing out that 62%. And on average, when you look at all those games, you would only make this much, right? So it's kind of better to spread out your probability. It's kind of better to spread out your probabilities, because even if your max gain is less, you're guaranteed some gain, right? So this is how I approach investing, right? Nothing is guaranteed. All we can do is kind of hedge and think about the particular gains and losses that we're willing to get and willing to experience. So given that, what is my strategy, right? And that's probably what people are gonna ask. What am I gonna do? Yeah, so right now we're at 0.3 risk. If we look at this chart, basically the highest gain is just equal, right? If I just spread it out equally, that's the highest expected realized gain, and it does a pretty good job at like the max gain as well. So I have a cash position that I want to invest into Bitcoin, and I'm gonna use 25% of that cash position now and hold off the other 75% from when it hits additional milestones. That way, when it goes down, I can still buy more and then benefit. But I'm not risking missing everything, because I would have had a foot in the door. And I think that's the best of both worlds, because you know, the best gain I could make right now in the 2 year is 121% if I just spread it out equally. Versus if I bet everything at the 1.0 risk, I would only make 30% more, but on average, I would lose like 30% more. Like, there's a lot more to lose than to gain. So I think it's okay. Yeah, so I think it's okay. I'm okay with getting wrecked in the short term. So if Bitcoin does hit the 0.15 risk and I lose 36% of the 25%, I think that's fine with me, because I will still have a cash position to invest, and that would still allow me to hit the expected gains that I'm comfortable with. Yeah, so it's all about what you're comfortable with and quantifying that amount of risk to take. Yeah, so that's basically it, guys. If you like this video, like and subscribe, and I'll see you guys next time.